Introduction to Bollinger Bands. Bollinger Bands are a popular technical analysis tool developed by John Bollinger in the 1980s. These bands are plotted around a price chart, giving traders insight into market volatility and potential price extremes. Bollinger Bands consist of three components. First, a middle band, which is typically a 20-period moving average of the price. Second, two outer bands place two standard deviations above and below the middle band. These bands expand and contract based on market volatility, making them dynamic and responsive to changing market conditions. Traders use Bollinger Bands to identify potential overbought and oversold conditions in financial markets. In summary, Bollinger Bands provide visual insights into price volatility and potential reversal points in financial markets. Bollinger Bands excel at measuring market volatility. The bands work by expanding and contracting in response to changes in market volatility. When volatility increases, the bands widen or expand. Conversely, when volatility decreases, the bands narrow or contract. This visual representation of volatility helps traders identify potential trend reversals or continuations. During periods of low volatility represented by narrow bands, the market is often consolidating before a significant move. Let's examine some key insights about how Bollinger Bands measure volatility. Understanding these volatility patterns helps traders anticipate potential market movements and make more informed trading decisions. The Bollinger Squeeze is a powerful pattern that occurs when volatility falls to very low levels. We can identify this pattern on a price chart when the Bollinger Bands narrow significantly. In normal market conditions, Bollinger Bands maintain a relatively consistent width as volatility remains stable. When market volatility decreases, the bands start to narrow, eventually creating what traders call a Bollinger Squeeze. This compression often precedes major market moves, as periods of low volatility are typically followed by high volatility. Traders typically look for the bands to narrow to their smallest width in 6 months or more, then wait for a breakout in either direction. A bullish breakout occurs when price moves strongly above the upper band after a squeeze. Conversely, a bearish breakout happens when price moves strongly below the lower band after a squeeze. The direction of the initial price bar that breaks outside the bands often indicates the direction of the coming trend. Bollinger Band bounces are one of the most common strategies traders use with this indicator. A bounce occurs when price approaches or touches one of the outer bands and then reverses direction. Let's look at how these bounces appear on a price chart with Bollinger Bands. When price touches the upper band, it may indicate an overbought condition, suggesting a potential sell signal. Conversely, when price touches the lower band, it may indicate an oversold condition, suggesting a potential buy signal. It's important to note that these bounce signals are most reliable in ranging markets, where price moves sideways within a channel. However, these signals should be confirmed with other indicators to increase their reliability. Here are some basic rules for trading Bollinger Band bounces. Wait for price to touch a band, look for reversal patterns, confirm with other indicators, and place your stops beyond recent swing points. Remember that Bollinger Band bounces are probabilistic signals, not guarantees. Always manage your risk appropriately when trading these patterns. Bollinger Band breakouts occur when price moves decisively outside one of the bands. Traditionally, moves outside the bands indicate potentially overbought or oversold conditions, suggesting price might revert back within the bands. However, breakouts can also signal the beginning of a strong trend, not just overbought or oversold conditions. When price breaks above the upper band with strong volume, it may indicate the beginning of an uptrend. Similarly, when price breaks below the lower band with strong volume, it may signal the start of a downtrend. Traders should not trade breakouts in isolation. It's important to look for confirmation from other indicators, such as volume, RSI, MACD, or support and resistance levels, and consider the broader market context. Bollinger Bands help identify two specific reversal patterns, W bottoms and M tops. A W bottom is a bullish reversal pattern that forms at the end of a downtrend. It begins when price touches the lower Bollinger Band, showing extreme selling pressure. Price then rebounds slightly from the lower band. The pattern continues with a second low that fails to touch the lower band, indicating decreasing downside momentum. Finally, price rallies above the middle band, confirming the BU bottom pattern and signaling a potential trend reversal. On the opposite end, the M-top is a bearish reversal pattern that forms at the end of an uptrend. The pattern begins when price touches the upper Bollinger Band, showing extreme buying pressure. Price then pulls back slightly from the upper band. The pattern continues with a second high that fails to touch the upper band, indicating decreasing upside momentum. Finally, price declines below the middle band, confirming the M-top pattern and signaling a potential downward trend reversal. To summarize, both W bottoms and M tops identify potential trend reversals through specific price behavior in relation to Bollinger Bands. The key signal in both patterns is the failure of price to reach the bands during the second peak or trough, indicating a change in momentum that often precedes a reversal. The Bollinger Band Width Indicator is a separate tool derived from Bollinger Bands. It measures the percentage difference between the upper and lower bands, allowing traders to quantify volatility. Let's visualize how the bandwidth indicator works with a price chart and Bollinger Bands. The bandwidth indicator measures the distance between the upper and lower Bollinger Bands. This distance is then expressed as a percentage of the middle band value, creating the bandwidth indicator. Low readings on the bandwidth indicator suggest compressed volatility, which often precedes significant market moves. High readings indicate expanded volatility, which may signal a potential reversal or continuation of the current trend. Traders use the Bollinger Band Width Indicator to anticipate major market moves before they happen. It helps identify consolidation periods that often precede breakouts, giving traders a heads up before significant price movements. Declining bandwidth can confirm trend exhaustion, suggesting a potential reversal or consolidation. For best results, traders use the bandwidth indicator in conjunction with price action and other technical indicators. Let's look at a practical example of how the Bollinger Band Width Indicator works with price action. Below the price chart, we can see the corresponding bandwidth indicator. Notice how the bands tighten and the bandwidth reading drops, indicating a period of low volatility or squeeze. This squeeze is followed by a breakout and expansion of bandwidth as volatility increases. In essence, the bandwidth indicator helps traders identify potential breakouts and market shifts before they occur, making it a valuable addition to any technical analyst's toolkit. Bollinger Bands become more powerful when combined with other technical indicators. Using multiple indicators helps confirm trading signals, filter out false signals, and increase the probability of successful trades. The first powerful combination is Bollinger Bands with the Relative Strength Index, or RSI. RSI helps confirm overbought or oversold conditions. When RSI falls below 30 and price touches the lower Bollinger Band, it signals a potential buying opportunity. Conversely, when RSI rises above 70 and price reaches the upper band, it suggests a potential selling opportunity. The second useful combination is Bollinger Bands with the Moving Average Convergence Divergence Indicator, or MACD. MACD helps confirm trend direction and momentum. When a bullish MACD crossover occurs while price is near the lower Bollinger Band, it creates a strong buy signal. Similarly, a bearish MACD crossover when price is testing the upper band generates a compelling sell signal. The third powerful combination pairs Bollinger Bands with volume indicators. Volume helps confirm the strength of breakouts. High trading volume, when price breaks through a Bollinger Band, significantly increases the reliability of the signal. Conversely, decreasing volume during price consolidation within the bands often precedes a Bollinger squeeze, setting up a potential breakout opportunity. While these combinations significantly improve trading decisions, it's crucial to remember that no indicator or combination is perfect. Even multiple indicators working together can generate false signals. Always implement proper risk management by setting appropriate stop losses and sizing your positions conservatively. Effective trading requires both technical analysis and disciplined risk management.